I want to bring James Bullard into all of this. You remember him, of course, the president of the St. Louis Fed, key player and a very keen read on how Fed think and central bank think goes. James, always honored to have you. I really want to put this in the context of the Bank of Japan, which startled folks when it went ahead and raised rates, startled them all over again. I kind of think this week by saying, you know, we might not do that for a while, as if they were afraid of the market fallout and what they started. So it begs a question. Should central banks be worried about how the market reacts to what they're doing?
Oh, absolutely. And I do think that the BOJ was trying to settle things down a little bit with this deputy governor's speech, I guess, yesterday or the day before. And maybe it did that to some extent. But I think attitudes have changed in Japan a little bit. You know, always in favor of the weaker yen, but I think 160 was a bridge too far, and they're trying to pull that back a little bit without too much volatility. But they got a lot of volatility on Friday.
They did. All the world did. I wonder, though, James, when you,
yeah.
Right, no, I understand. When you were on the Fed, how closely did you look at the markets? Sometimes, I think I've raised this with you in the past, did the market misinterpret a decision or a statement or a speech that you made or gave? And it bothered you to the point where you had to react to it? Or do you just ignore it? It's noise.
Well, I mean, markets are notorious for going too far in one direction or too far in another direction. And that's why the Fed has not wanted to react directly to the stock market, because you can really get into a kind of losing game where you adjust policy one way and then the market goes the other way. And it can really backfire. So I think the Fed tends to want to produce, you know, we're not going to react to a particular number. You're going to take a more measured assessment of the situation. And that tends to be the rule, even when there's a lot of market volatility.
But, you know, James, isn't there a risk that the markets are bullying you? Not you specifically, but that, you know, we can get the Fed nervous and we can, you know, rant and scream and stomp our feet, and they'll do something because they get nervous and we've got their number.
Well, at the Fed, they like to think that that does not happen. It is a dance, I would say, between because I guess what I've said about this is both the Fed is trying to assess the state of the macroeconomy. The market is trying to assess the state of the macroeconomy. If they're on the same page, then everything works fine. If they get a little bit different interpretations of the same data, then you can get some confusion about how that's affecting future monetary policy and therefore future valuations in the market. So to keep everybody on the same page, I think the best way to do that is have pretty constant communication about here's how we're interpreting the latest numbers. Here's how the Fed is thinking about the latest data. And that tends to keep everybody on the same page. But sometimes things occur and they get on different pages.
It's easy to play Monday morning quarterback as we look at the Fed and the markets. And, you know, when Jerome Powell was talking to... You're right. But when Jerome Powell was addressing the no change in rate decision on the part of the Fed, I mean, he gave a very sanguine outlook for the economy and things are going okay. Then along comes the Friday employment report and the market panics. For all I know, some of your colleagues and old friends on the Fed, they might be panicking. But in retrospect, a couple have said that would it have been wise for the Fed to make a cutting move at that meeting? Some had advocated, Alan Bullard, the former vice chair of the Fed. What do you make of that? That easy for them to say shoulda, coulda, woulda. They never did. What do you think?
Yeah, I think the Fed's had a pretty successful run here with the 2022 policy, 475 basis point increases in a row. Then you got a lot of disinflation in 2023 and even into this year without causing a recession. So it's all been pretty good. But the moment to pull back, you know, is getting very, very near. I think the committee signaled about as clearly as they can that they're ready to go in September.
By how much you think, James? By how much you think?
I thought it was maybe a little too late, but still, in the macroeconomic scheme of things, wouldn't matter too much if you started in July or you started in September. So I think they're in pretty good shape, but there is a debate now, and I think a good focus for markets is like, how fast will this go? Now, if you start in September, you want to go to every meeting, 25 basis points. You want to go slower than that, faster than that. That's a very live debate right now, and pretty much all the pieces of the soft landing have come into place, except that the policy rate's still pretty high. So how fast do you want to get to the neutral policy rate? And I think that's a key thing here.
You think it'll be a 0.5 point cut? That's what the markets seem to be factoring in.
As of where we are today, I think it's going to be 25 and then another 25 in November, but we'll see.
All right. Always good talking to you and getting your perspective, James Bullard, the former head of the St. Louis Fed.